right, why don't we go ahead and get going then? Once again, my name is Jason Richardson. I'm the Director of Research at the National Community Reinvestment Coalition. Today, I'm joined by Jamie Buell and the Director Josh Devine from our Racial Equity team. And we're presenting today on a report that we've written on the mortgage lending from 2020. And actually, we look at 2018 through 2020, but it's called the 2020 Home Mortgage Report. And I'm going to put a link in the chat to that in just a few minutes. Can we go to the next slide, please? But a little housekeeping first. The National Community Reinvestment Coalition and its grassroots member organizations create opportunities for people to build wealth. We work with community leaders, policymakers, financial institutions to champion fairness and indiscrimination in lending, housing, and business. Next slide. We provide agenda-setting research, training, insight, and advocacy on behalf of members. We renovate and build affordable homes for low and moderate income families. We provide counseling to home buyers and owners and business building expertise to entrepreneurs. We train and support housing counselors nationwide. We test, monitor, and challenge discrimination in financial services and housing. And we convene and facilitate dialogue between financial institutions and community networks to increase lending, investments, and philanthropy in neighborhoods that need it. Next slide. So we're going to go over our HMDA report, and I'm going to talk for a little bit about a couple of sections, and then my colleagues are going to discuss a couple of more sections, and then we're planning on having a good 20 or 30 minutes at the end for Q&A. So remember, at the bottom of your screen is a Q&A box. Please click there and you can enter your question, and one of us will do our best to answer it. This call is recorded, so you should receive an email shortly following the today's presentation with a link to that recording if you want to take a look there. Also, I'm going to put a couple of notes in the chat. These are links to the report and also links to our Maggie with our membership team if you have any questions about membership, and some other information about research that we've done. And one moment here, let me send that out. Next slide, please. On January 18th, we released a report on mortgage lending covering the time period 2018 through 2020. Now, this report uses the Home Mortgage Disclosure Act data, pronounced HMDA, which includes about 88% of all mortgage applications, or over 58 million records for the time period we're talking about. Next slide, please. In 2018, the CFPB took over collection and reporting of HMDA data, and they updated it to a new format with many new variables. And this is our first chance to look at 3 complete years of that data. It's important because it gives us a chance to really look at trends in the data for the first time. And of course, it covers 2020 during the pandemic, which was interesting for a lot of reasons. Now, NCRC offers several ways for our members to take advantage of this data for their advocacy work, including our Fair Lending tool, which lets you drill down into lending details in your communities. We also help members better understand this data and leverage it to further their goals. If you're interested in this, please ask your organizer about it today. And if you're not a member of NCRC yet, please contact Maggie at the email address in the chat box. Next slide. So report details. This report's rather large, so we're going to touch on a few of the topics that we discuss in the report, and then we're going to go through some of the more interesting statistics, but there's a lot in there that we can't cover in the short time that we've got today. So again, take a look at the report, and if you have any questions now, by all means ask them, or if you think of any later on, let us know. We're happy to answer and answer any questions and clarify anything. So this report, first off, does look at the total number of mortgage applications and originations. And we look at 2018 to 2020 lending by race, ethnicity, and neighborhood status. And by neighborhood status, I'm talking about the income and the demographic composition of the census tract where the loan occurs. We also spend a lot of time looking at disaggregated demographic data that is new in HMDA in the last 3 years. Hawaiian, Hispanic, and Asian borrowers are offered the chance to more precisely identify themselves, and they have done so enthusiastically. So we're getting data now that we haven't ever seen before, and a level of detail in the data that's really encouraging. We also take a look at loan pricing and loan details. Now, these are things like closing cost, origination rates, interest rates, things like that. And we look at how those differ between different types of lenders, and then between different types of borrowers and neighborhoods. Next slide. We also take a look at top lenders and top metro areas and see how they differ from one another, also in terms of their lending to BIPOC or LMI borrowers and in majority minority and LMI neighborhoods. We pay particular attention to lending activity for LMI borrowers, excuse me, and especially in the home purchase and refinance space. And in the report, you can actually interact with a lot of the graphics to more precisely kind of look at different types of loans. We're going to show an example of that in a minute, but it's an interactive report. So by all means, check the link in the chat and go take a look at it. We also take a look at equity at closing. This is the difference between the amount that the borrower has borrowed and the property value. This is also new data just available in the last 3 years. The potential or the equity at closing is a great measure of wealth. And we know that housing is a key component of household wealth and the racial wealth gap. Next slide. We also touch on other statistics in some depth, but there's not a lot of detail. We're going to be expanding a lot this year on with new reports, blog posts, and research briefs that expand, looking at some of these specific data points. For example, we do talk about older adults and lending, and it looks at trends in older adult lending over time and trends in reverse mortgage lending. For example, reverse mortgage lending increased sharply in 2020. What that might mean is still a matter for research, and we hope to take a look at that more closely later on. We also look at lending by gender and same-sex status, discussing the market share of male and female borrowers, as well as same-sex couples and how that's changed over the last 3 years. Additionally, we look at biracial lending. So the Census Department has reported an increase in the number of people that report that they are biracial or multiracial. And we do see an increase in the share of lending that has a biracial applicant as well. Next slide. We're going to talk about some of the specific takeaways from the report right now. Next slide. So some key takeaways. Refinance lending grew dramatically during the pandemic, and we think that it disproportionately flowed to non-Hispanic white, Asian Indian, and Chinese borrowers. The private or conventional mortgage lending market continued to inadequately serve most BIPOC families. The gap in homeownership rates between Black and white families remains near a 120-year high point. Most BIPOC communities saw their share of mortgage lending shrink between 2018 and 2020. Over decades, the conventional mortgage market and laws intended to expand access to credit have failed to achieve equitable homeownership rates or increase family wealth in BIPOC communities. Policymakers, community leaders, and lenders themselves should rally around bold new approaches, race-specific goals, and performance requirements. Next slide. So I just want to give you an idea of the scale of the lending in 2020 compared to previous years. In 2018, there were 14 million loan records reported under HMDA. That grew substantially in 2019, and we can see most of that growth was in the refinance space. That's the lighter blue color on the far right side. In 2020, the number of refinance loans more than doubled, and we have over 15 million refinance applications in the data set this year. A much more modest growth in the number of home purchase loans, but there was growth in both areas. But this is just an idea of the scale. We saw the overall data set grow to over 25 million records in 2020 alone. Next slide. This is an example of one of the charts throughout the report. This shows the number of originations per year and the share of those loans going to each individual racial group. Now, a few notes from this. There was a small decline in the share of loans with a white applicant between 2018 and 2020. It went from 67.3% down to 64.9%. However, this drop was more than offset by an increase in loans lacking any data on race and ethnicity. So it's difficult to tell if those numbers of white borrowers really declined overall as a share, or did many white borrowers simply not report their race and ethnic status on these loans. My sense is that the no data loans probably skew a little bit towards white and Asian borrowers, but it's impossible to tell for sure. Within the BIPOC communities, We do see a growth in Asian lending. 5.4% of loans in 2018 went to an Asian borrower. That grew to 6.5% in 2020. Most of that growth was in the Asian, Indian, and Chinese communities. And I think Jamie's going to talk more about that in just a minute. The percent of loans going to Black borrowers, Hispanic borrowers, and Native American borrowers, as well as Hawaiian or Pacific Islanders, actually fell between those 3 years. Likewise, we also saw declines in loans to LMI neighborhoods, which fell from 16.5% of lending in 2018 to 13.7% in 2020. Loans in majority minority neighborhoods also fell from 19.1% in 2018 to 18.5% in 2020. Next slide, please. So what does this mean? When there's a long-term gap in who is getting loans, you're going to see a long-term gap in home ownership as well. This chart looks at home ownership rates for Black and white families in the United States from 1900 through 2020. And what you'll note here is that in both cases, you see an increase over time in home ownership rates. However, the gap between those two, that space between those two lines, roughly stays the same during this entire period. Can we go to the next slide, please? This is the white and Black home ownership rate gap over time, represented by the blue bars at the bottom there. And you'll note that throughout the entire 120-year period, it doesn't vary very much. The average gap was 25.3%. That was at its lowest point in 1980 at 23%. But in 2015, it actually reached its highest point yet of 30%. It's declined very slightly from that, but we are still at near the top of the range in terms of a gap between Black and white home ownership. You'll note that this doesn't change throughout the entire period, despite historical events, despite civil rights acts, the Home Mortgage Disclosure Act, and the passage of CRA. So this remains an intractable problem that drives a large portion of the racial wealth gap in this country also. Next slide, please. What does all this mean? Well, many borrowers and homeowners of color were excluded from taking advantage of the market's low interest rates, and this hinders their ability to build wealth. Over the past year, white and some Asian borrowers or homeowners have been able to dramatically lower their interest rate, which is going to speed up the way that they accrue wealth. The marginal increase in BIPOC home purchase lending that we observe does little to move the needle on homeownership gaps. Particularly the white-Black homeownership rate, as I discussed, has remained almost unchanged for 120 years. Disaggregated racial data on Hispanic, Asian, and Hawaiian or Pacific Islander borrowers is critical. We recommend that the CFPB expand the collection of this data to other racial groups such as African Americans. Next, loans lacking race and ethnicity data have grown to 15% of all loans, and this masks the true extent of disparities in the home lending market. This is of particular interest to me because I work with this data all the time, and every year more and more of the loans lack any race or ethnicity or income data in some cases. So that's very concerning for us. Next slide. At this point, I'm going to turn it over to my colleagues. And remember, if you have questions, please put them in the Q&A box at the bottom or ask the question in the chat, but it's a little easier if you use the Q&A box. Thank you very much.
Thanks, Jason. For the overview, I'm going to talk about loan pricing and loan details and how they vary by race and other demographics. In the next slide, just providing an overview, broadly speaking, regardless of race, the interest rates from 2018 to 2020 currently decreased about 1.6 percentage points. So currently in 2020, interest rates for average was 3.3%, and total charges or closing costs have remained relatively the same. In 2020, it was an average of $4,344, which is just about $320 more than in 2018. But of course, there are a lot of broad disparities in these loan prices and interest rates according to demographics, which we give a breakdown of in the next slide. I know that this graph is a little bit hard to read, but basically the x-axis is the interest rate with the y-axis being total charges. So you can see that Black, Hispanic, Hawaiian, and Pacific Islander borrowers had much higher average closing costs of around $5,500 to $5,600. And you can see that they're concentrated at the upper end of this graph, while white counterparts had an average closing cost of around $4,000 and an interest rate of about in between 3.1, 3.2%. And interestingly, you can see almost all of the Asian groups are concentrated at the lower end of both interest rate and total charges, with the lowest interest rate being for Asian Indians at 2.9%. And moving on to the next slide, getting also into some of the disparities in loan pricing and costs is a discussion around traditional banks versus mortgage companies and their lending. In 2020, we saw mortgage companies really expand their presence in the market. In 2018, they comprised 44% of the total market, whereas in 2020, they increased their presence 14 percentage points to 58%. And when you look specifically at home purchase loans, mortgage companies comprise 62% of all home purchase loans. And interestingly, mortgage companies are lending substantially to Black and Hispanic borrowers, which may be in part due to their greater usage of government insured loans. So loans insured by FHA, VA, or rural housing services. To give you an idea of this, mortgage companies' loan portfolio, total mortgage companies were comprised 40.7% were government-backed loans, whereas traditional banks' loan portfolios in total was 18.8%. And if you look in the report at specifically the largest traditional banks, few made any government-backed loans at all. And this is particularly important, moving on to the next slide, because Black and Hispanic borrowers and Hawaiian and Pacific Islander borrowers, as well as Native American, really rely on government insured loans, both for home purchase and for refinancing. When you look at this graph here, you can see that the majority of Black borrowers, some Hawaiian or Pacific Islander subgroups, and almost a majority of Native American home buyers and refinancers use these government insured loans. And one really interesting point about our more granular and disaggregated data is this subgroup breakdown. So although most Asian subgroups rarely use these government insured loans, most Asian subgroups around 14 or less percent, you can see that Filipino borrowers, interestingly, have a rate of using government insured loans 22 percentage points higher than the general Asian population. So this disaggregated information definitely prompts further research into looking at to why there may be these disparities or discrepancies among subgroup populations. All this information about government insured loans and its different costs is important. Also going into the next slide, because government-backed loans are incredibly crucial to enabling homeownership for those who it may not otherwise be possible for without these loans. However, it is important to note the higher closing costs that are associated with these loans. So in this graph or table here on the right, we give a breakdown of exactly what we mean by costs at closing. But you can see here that FHA, RHS, and VA loans have much higher total charges at closing, while also being coupled with much lower home equity at closing, which we previously mentioned was the amount of the loan subtracted from the home property. So when you couple the fact that there are higher closing costs plus much lower home equity at closing, and considering the fact that these government insured loans are much more used by lower income, lower wealth households that are really in need of asset accumulation and wealth building, the fact that they are paying more and accruing much less wealth is concerning and is something to be thought about, and begs also for more research and further attention. Moving on to another interesting point is denial rates that had some interesting trends in 2020. Denial rates across most BIPOC communities were almost halved between 2018 and 2020 for refinance and cash out refinance lending. Interestingly, amongst home purchase loans, all demographics had a decrease in denial rates, except for Black home purchasers who actually had a 1.4 percentage point increase, Hispanic home purchasers who had a slight increase in denial rates, and borrowers who were buying homes in low to moderate income neighborhoods also had a decrease in denial rates. Moving on to the next slide, we can look closely at the reasons for these denial rates. The main reason that it reported in HMDA that reported a significant, or sorry, excuse me, a substantial decrease was credit history. You can see in 2018, it was 29.7% and decreased to 24.8%, almost a 5 percentage point decrease. But we believe that this does not indicate that mortgage credit requirements have eased, but rather that the pool has been skewed by a lot of higher earner demographics with maybe higher credit scores that have been capitalizing on historic low interest rates and home prices in 2020, and skewing the data to show that credit history amongst the population in 2020 was less of an issue because of the higher earners and the demographics dominating the pool. So moving on to discuss why all of this matters. Again, due to their lower down payments and flexible credit requirements, government insured programs are really critical to homeownership for many BIPOC groups. However, banks rarely make any of these loans, meaning that BIPOC homeowners are more likely to work with non-bank lending institutions like mortgage companies that are not covered by CRA. And these loans are more costly than conventional alternatives offered by traditional banks. So similar to down payment assistance, there needs to be some thought into interventions and solutions to the extra costs associated with government-backed loans to address a home equity gap, as well as devising some solutions to making either government-insured loans more available or mortgages with similar qualities available to address the homeownership gap. And then we'll move on to talk more about some trends with Josh.
Thank you, Jamie and Jason. Just a reminder that Q&A is still open for questions. I see we're answering some of them via the chat, but we'll also pause at the end of this presentation to address them openly. But thank you for those who have already submitted your questions. It's important to, as we examine the HMDA data, to think about lending activity as relates to LMI borrowers, LMI census tracts, majority minority communities, and also further underscore what these trends mean in terms of homeownership access and building wealth. So in closing out the presentation today, I'll take a few moments to talk through some of our data related to LMI lending and some critical takeaways in support of such. So on the next slide, just to reiterate maybe Jason's earlier point, we do see a decrease in LMI lending to LMI borrowers, and the same trend exists for lending to majority minority communities. What HMDA data reveals is that the mortgage companies in particular saw their lending to LMI borrowers fall within 2018 and 2020. What we know on the home purchasing lending side of the house, we saw very little change, but when we analyze lending within the refinance market, we can see stark differences in refinancing loans to LMI borrowers. Mortgage companies, for example, decreased their lending to LMI borrowers from 31% to 19% between 2018 and 2020. In a very similar trajectory, refinancing loans to LMI census tracts. So what these trends really allow us to understand that there is a direct implication that the decrease in lending has on lower wealth borrowers and people of color. When you take a look at these trends across race, it's critical to note that in 2020, Black and Hispanic borrowers accounted for a large portion of those loans that were made to LMI neighborhoods and LMI borrowers. And for the person who asked the question about the Hispanic community, you can also see in this chart on the slide that 26% of the loans to LMI neighborhoods were of Hispanic buyers. In similar vein, 31% were LMI borrowers. Jason or Jamie mentioned earlier about the importance of disaggregated data and the unique tool or a unique resource to help understand even subgroups, particularly within the Asian community. So even as we're thinking about loans to LMI borrowers across race, we can also see some differences within the Asian market. So for example, only 8% of Asian Indian homes that were purchased were in LMI neighborhoods. And that's in comparison to, say, the Vietnamese population, where 23% of those loans were given to that particular population cohort within LMI neighborhoods. What's not pictured on this slide, but included in the report, are top lenders by race. So you can get a good opportunity to look through some top institutions, top lenders, and understand their performance in 2020 and the racial makeup of their loan portfolio also within that year. On the next slide, we included in the report calculations in housing equity at closing, taking advantage of some of the property value and loan amount detail that HMDA makes available. And as we began to analyze this particular data, we found some really clear patterns across racial lines. For example, Chinese borrowers in 2020 were closing at with higher levels of equity in their home purchase than, for example, Black home buyers. The equity difference is seen in that first bullet there. Chinese home borrowers, closing at around 220K in equity as opposed to just 36,000 in equity for a Black buyer. Other racial groups that are on the kind of higher end of those who closed high on equity include Asian Indians, Japanese buyers, and even white Americans. Racial groups that were closing on the lower end of that equity spectrum include folks like Black Americans, Puerto Ricans, and even Native Americans. When we kind of take a look at these equity calculations and compare them to what we know about LMI lending, we can clearly see the important role location plays as we think about how communities, in particular racial groups, have access to home ownership, but also to subsequent equity overall. So only 13% of Chinese borrowers, for example, were located in LMI neighborhoods. But the data also suggests that Chinese borrowers are reporting a high average of property values at north of 800,000. And that's in comparison to, say, Black borrowers who are reporting an average property value of 325,000, even though we know that 26% of Black borrowers are actually LMI. And most likely, in the same vein for Puerto Rican borrowers, who are most likely buying properties within LMI neighborhoods, but having the lowest average property value of just north of 300,000. The next slide, we were able to kind of use this data and juxtapose this lending data or LMI lending data in the housing calculations with an analysis of the top 50 metros that reported the most home purchase loans in 2020. So again, in assessing these metros across a number of variables from neighborhood details to borrower details, we also see differences in lending activity and equity return. So again, for example, taking San Jose, which reported the largest average loan amounts as well as home values, but also ranked the lowest or some of the lowest of the top 50 metros in the number of home purchase loans given in 2020. Buyers within this particular market averaged about 400,000 in equity. And that number is in context to what we know about the portfolio of loans given to that area, meaning only 9% of those loans were to LMI borrowers within that market. That's in contrast, again, to places like Louisville or Cincinnati or Indianapolis, who within their metro, or the loans given within their metro, it's over 40% of those loans were given to LMI borrowers. And those home buyers within those markets are averaging equity at closing at equal or less to $50,000. What these trends really underscore is again, the importance of location, the importance of home valuation, and the importance of how homeownership actually builds wealth and it builds a wealth portfolio of racial groups across all wealth levels. There are also other ways to really parse through this particular data with this top 50 metro analysis. We could either isolate top 50 metros that are reporting over, say, 40% of loans going to LMI borrowers and really assess those particular markets, or we can isolate the top 50 metros that are reporting a high number of purchasing loans and really understand the nuances between those, even asking questions such as why only half of those top 10 metros are actually, or loans within those metros are only 30% going towards LMI neighborhoods. I think the point of the matter is that we need more lending to LMI communities and LMI borrowers, and that's not often reflected within the 2018-2020 numbers. So on the next slide, so why does this all matter? Just reiterating some points in the earlier presentation, a marginal increase in home purchase loans given to BIPOC applicants doesn't necessarily rise to the challenge and the opportunity really that we have to closing homeownership gaps that exist today. So it's really critical and important that we think about how lending institutions play a unique role to closing that gap. Uniquely, because of the disaggregated data, particularly within the Asian market, we have an opportunity to think about HMDA data and how it relates, or how the mortgage market plays a part in thinking about racial nuances. For example, though we know that Asian market dominance existed, particularly within the refinancing space and growth in refinancing, we do know Filipinos, for example, actually lost market share from 14% in 2020, and the loss of 11%. So understanding the different socioeconomic conditions and wealth levels and financial conditions of racial groups and sub-racial groups can really help us underscore a little bit more about how the mortgage market is enabling wealth and wealth growth overall. And lastly, just thinking about market concentration in the bars of color, it really helps us understand the barriers that exist for home ownership. So as we look at high cost markets where there are high property values and home buyers are close to that higher equity, we could take a closer look at the impact that has on actually bridging the racial wealth divide. And the inverse to that is communities in slow markets with lower property values. And how do we kind of change the narrative and shift the trend there? And also, what we know about wealth development and portfolio overall in both acquisition and asset acquisition overall, Black and Hispanic families hold most of the wealth in their primary residence. So when we think about the rate of equity at closing for Black Americans or for those other racial groups in that lower spectrum, we got to think about how we can do a better job at either valuing those homes at a higher price or thinking about ways in which we could enable or accelerate wealth growth through homeownership for those particular racial groups. So in closing, here's all of the things on the next slide of what we can do in response to the data. We see an opportunity to do continued innovation around mortgage product solutions and helping institutions understand products and services that are more accessible to BIPOC communities, how they set the infrastructure to support access to those particular products, as well as how they partner with organizations to develop programs and resources that are tailored to LMI communities and home buyers of color to reach the homeownership goals that we hope to achieve over the next decade. NCRC does a lot of policy and advocacy efforts, more specifically, more recently, thinking about updating HMDA data or to really explore these trends across race and ethnicity. How do we approach the missing demographic data that we're seeing, and how do we really leverage HMDA in a way to help protect lending or abusive lending that happens within these markets in the subracial groups who need access to housing and homeownership products, as well as extending the CRA, for example, to hold mortgage companies accountable, particularly as they grow their market share. So we do a lot of coalition building, a lot of research. Uniquely, what's interesting about the Racial Economic Equity team is we're working closely with Jason, the research team, in a housing policy shop to really further refine and focus our efforts on these issues in the mortgage market through a race and ethnicity lens. So we're looking forward to really taking a deeper dive into problems and practices, particularly as it relates to housing affordability, preservation, and development. And we love to continue to partner with you all. So I want to reiterate the role, the membership opportunities that we have, as well as the unique opportunities and contacts that we can share with you all, so we can continue the conversation over the course of the next year. So I'm going to pause there and pass the mic back over to Jason.
Thanks, Josh. Thanks, Jamie. I appreciate it. So we've got a lot of great questions already in the chat. And I'm going to do my best to get through some of them here. I try to answer a few by text. And Josh, Jamie, if you want to jump in here, there are a couple though great ones about data quality and appraisal discrimination that I'll address. There was a question about data quality on household income in the data set. And we have, so the HMDA data set, the new variables that were added recently, we have seen some issues with outliers, especially in interest rates and rate spread data. There's some details in our methodology section about how we account for those. We haven't seen any issues with household income reporting, but that doesn't mean that there isn't something on the origination side that is making its way into HMDA. Excuse me, but we're not seeing the outliers that we see in some of the newer data points. So we talk about that a little bit, and we've done our best to filter out those outliers. If you're working with HMDA data, you need to account for that though, because they can slip in and really throw off your analysis. There were a couple of questions about appraisal discrimination. Our report does not get into the appraisal discrimination issue, but it's a topic that we're really hearing a lot about. And what they mean by this is that there is both a systemic issue where segregation leads to lower valuation for properties that tend to be in LMI or BIPOC communities. And then there is the issue of in-person discrimination where human appraisers use value judgments to assign values that are driven by the race of the occupant that they perceive. So those are two serious and separate issues that we need more testing on. We need more enforcement on. I don't know, Josh, Jamie, there were a bunch of questions here. Do you want to take? Any that you want to take, or I can just start going through them?
There are a few questions related to the top 50 metro analysis and whether or not we can get a little bit more local insights as relates to lending. And I do know we focus primarily on the metro level, but maybe Jason, this is a data methodology question.
Yeah, so members of NCRC have access to a number of tools, including the Fair Lending tool. It's available on our website at ncrc.org. And that does let you create custom reports for your county, your metro area, where it looks at a lot of these same things in more detail than this report does. In addition, NCRC members can always talk to me and see about getting specific data that they need for their work. If you're working on a report of your own, or if you have a presentation coming up and you need a couple of statistics, if you're a member of NCRC, it's member benefit. Email me, I'll figure out what you need, and if we can provide it for you, we'll do so.
And we do understand that there are different variables that play that become a factor when we're analyzing metros and local regions. So the top 50 metro takes a look at the number of home purchase loans, taking a look at those loans either going to LMI borrowers or BIPOC borrowers, and then some average data around interest rates, property value, and even equity at closing. But we know that, more nuanced information around, population trends, available housing inventory, racial and income landscape of that local community kind of adds more complexity and context to those numbers. And we're looking forward to digging a little bit deeper into that analysis.
And I'll say something about the equity at closing statistic. It's exciting to work with this because we know that home equity is one of the largest drivers of homeowners of family wealth overall. So the ability to get a snapshot of where home buyers are at in terms of their home equity at closing gives us a window into the relative wealth of different racial and ethnic groups at a much more detailed level than we've been able to get in the past. So that's very interesting for us, especially since we understand the role that housing plays in wealth and in the racial wealth gap. Here's a question from Matt. Do you look at trends in applications, less applicants for certain races, which impact origination numbers? Well, in 2020, due to the interest rate changes, we saw an increase in the raw number of applications overall. What we're more concerned with is that most BIPOC communities have lost market share, meaning that primarily white, non-Hispanic, and Asian, Indian, and Chinese borrowers have increased in number, while most other BIPOC groups have decreased as a share of overall lending. So while we've seen an increase in lending to all groups, the wealth implications of this are substantial, as the families that are able to take advantage of this low rate period are going to build more wealth more quickly than those who are locked out from this point. So yes, thank you. Here's a good question from Anonymous. Let me see. Talking about why one downfall of mortgage companies compared to banks is that mortgage companies aren't federally backed, and therefore they are not covered by CRA. Can you please expand on why this is an issue, and are there advantages, disadvantages of servicing a loan through a mortgage company over a bank, or vice versa? So NCRC is a proponent of expanding CRA to cover non-banks, and this has already been done in several states, including Massachusetts, Illinois, and I think New York. And there's been there's no problem with getting mortgage credit in those places. And it does, it does mean that mortgage companies are held to a standard where they are required to lend to the entire community, and they can't cherry pick just the wealthiest or whitest areas. And we think that that's a good policy in general to have, especially as mortgage companies take on a larger and larger role in the market. In 2020, mortgage companies issued 62% of home purchase loans, and they issued 58% of all mortgage loans overall. So the fact that they're not covered by a critical piece of legislation like CRA is problematic, and we hope to see that expanded soon.
We also note in the report that as mortgage companies become more prominent in the market, they're oftentimes using online vehicles to service their loans, right? Which means more accessibility to some markets, particularly underserved markets. So as we think about data and understanding the data and holding accountable the mortgage market, we want to be sure that we have the right intel and the right insight to understand how mortgage companies are actually engaging with these populations, or not engaging, and what we could do about it.
Mm-hmm. Yeah. Let me see, there's a question here. Do any banks lenders have the ability to have mortgage programs based on race and ethnicity? So that would be illegal because you can't target a specific protected class for a specific type of credit. But there are programs that we know would positively affect rural populations, low-income families, and BIPOC borrowers, including conventional loan programs that have very low down payment requirements, or a broader credit box to make it easier for first-time buyers to get into the market. Currently, we do see most of those loans going through FHA or the VA programs, or the RHS program in rural areas. However, the higher cost of those programs is problematic. It means that a family who has to go FHA has less money for a down payment because they're paying a much higher closing cost. So we'd like to see wider adoption of conventional products that mimic some of those features, and that we think would have a positive impact on borrowers who are overly reliant on those type of loans, which, as we said before, most of the Hispanic groups as well as Black borrowers would all be positively impacted by that.
We've also heard from some communities trying to circumnavigate that racially explicit law or rule by getting at things and using proxies of descendants, or having ancestors who are in redlined areas or living in culturally significant areas. So there's some organizations and communities that are trying to innovate and find approaches to getting around that caveat in the legislation.
And just to reiterate Lori's comment in the chat, I do think the special purpose credit program clause does allow for racially explicit programs if there's an argument or justification as to why that institution may be missing that particular market. I think I think Amelia's question is our question as well, to try to inventory those examples across the market and maybe amplify what we believe or understand is working across the board. So looking forward to learning more about that as we go.
And as Kevin and Lori are noting in the chat right now, special purpose credit programs can be racially explicit. Thank you. Let's see here. Several other questions. What have you done to get banks to help prospective buyers who are rejected for loans to get them approved? That's Gerald in the Q&A box asking that. That's a great question. So a lot of lenders do have relationships with housing counseling agencies, and NCRC is a housing counseling agency, and we provide training for housing counselors as well. Actually, if somebody wants to put EBJOK's email in the chat, that would be great, because the director of our housing counseling network can answer more questions about that if you have it. But that that is one option there, where a borrower who might get rejected can be assisted by a housing counseling agency to get them to the point that they would be approved for a loan. That would be ideal. Jackie asked, has anyone heard of large lenders actively speaking on these issues or how they are contributing to the conversation? So NCRC is in conversation with most large lenders and banks about their lending activity. And we just signed a new community benefits agreement with, done so many this year, I just forgot. Josh, who was this one with? Anyway, let me look real quick. I don't have a screen in front of me where I can look it up. Was that Josh? I think we may have lost Josh there. Oh, okay. But the community benefits agreements are something our team works with our CBA team on, and we look at lending by particular institutions, and we encourage them to increase lending to BIPOC and LMI communities. And then we monitor those agreements over time to make sure that they are meeting those agreements. And we work with coalitions of members in areas where those lenders are active to help them work with that lender and make sure that those numbers are met. So that's a good program, and we continue to sign new CBAs every year. Josh, were you able to see who we just did it with?
New York Community
Bank. Dang it. Let me see here. Yep. Thanks, Rowan. Yeah, NYCB and Flagstar. That's right. So there, and let's see here. The question in the chat, actually, Kevin Stein, you might have take a look at this. It's a question on, are any of us aware of larger lenders or mortgage companies that have housing-based special purpose credit programs that focus on BIPOC borrowers? So I don't know. I'm going to crowdsource that answer also. If anybody on the call has an answer to Amelie's question, please put that in the chat. Let me see here.
Cleo had a question around, there's specific tribal loans for Native American ethnicities, and why is it considered illegal for a program geared to African Americans? It's sort of a counterintuitive safeguard. The intention to prevent discrimination by race early on has mandated it legislation to be race neutral, but then of course that counterintuitively makes it difficult to implement programs that do specifically target or want to bolster homeownership for Black or Hispanic populations. For tribal communities, I think because they are a protected class and a specific designated community, tribal lands have their own sort of jurisdiction. I think that might be why that is legal, but I'm not sure if Jason or Josh, you also have any additions to that.
No, I'm sorry, Josh, I don't, but I just wanted to say also that if in the conventional mortgage market, ECOA, the Equal Credit Opportunity Act, does prevent lending based on any protected class status, which would include race or ethnicity. And that's intended to prevent people from just lending to white borrowers. but it cuts both ways. Since they can't use race explicitly in their underwriting requirements, it means for conventional lending, it's you're not going to be able to lend, have a program just for specific racial groups. One of our initiatives with the CRA modernization discussion has been inserting race-specific requirements into the CRA exams that banks have to go through. And that's something that we hope would have an effect on pushing more lending towards BIPOC communities. There's a lot of questions coming in. So Jamie, Josh, if you want to take on any of them, by all means.
There's a question from Saul asking, would there be a way to track equity at different periods, like 10 or 20 years after purchase? It would be interesting to see the rates at which different groups accrue equity at closing. We're also definitely interested in that, especially to analyze how to impact the racial wealth divide over time, because this is the equity at closing number is a static number. We are still trying to think through a methodology of that. I think, trying to maybe think through the rate generally, historically, people appreciate their assets would be a way to maybe think through it, but that's definitely something that we are interested in looking into further, thinking through equity built through homeownership at closing and how it could impact the racial wealth divide generally.
So there are a couple of questions in the chat I want to address also. Greg has talked about in Oregon, in addition to our increased focus on BIPOC communities, we're also focused on increased engagement for veteran population. So HMDA does include VA lending data. So we can slice the data and look at VA lending by race, ethnicity, age, cost, so forth and so on. There was just a report, excuse me, we assisted Representative Katie Porter's office with a report on churning loans in the VA community. And part of the issue here is that very few lenders make VA loans. And so you do have a small group there, and some of them are being accused of churning loans, meaning that they make a home purchase loan at an interest rate that's here, and then a year later they hit the same borrower for a refinance to bring their rate down. It's called loan churning, and I do know that Katie Porter's office has been active in pushing the Justice Department and the CFPB to look more into that. And then Dennis said that Fannie Mae has opened credit qualifying to include rent payments. So that's a question about the use of data that's normally not in the FICO score. And there is an increasing move to include things like utility and rent payments. Vantage Score, of course, has been uses that metric where it uses alternative data. And yes, there are some indications that it will give borrowers who otherwise wouldn't have sufficient credit, enough credit that they can get a credit score. Whether or not it has a positive impact on LMI or BIPOC borrowers, I don't know yet, but it's an interesting development and we're encouraged by it. Oh, and one last question on the equity by age. So this data would need to come. So the HMDA data is only origination data. It isn't longitudinal. It doesn't follow the same borrower over time. Servicing data would do so, and I would look to FHFA's public use data, which does not include this information yet. It's not that detailed, but it could be in the future. So it would be otherwise you'd have to look at like a large mortgage servicer and like PennyMac or something like that and get a data set from them that might let you track such a thing. And I'm sorry, there was a question here in the chat. There were a couple of questions about some terms we've used, and I think that we kind of glossed over them. BIPOC is a acronym for Black, Indigenous, or people of color. And LMI is a low to moderate income. So it's a HUD definition, and a person who is low to moderate income makes 80% or less of the median income for the metro area they're in. A neighborhood is considered LMI if the median or the average income in that neighborhood is 80% or less of the median family income for the metro area as well.
There's a question asking why is the Asian community so far to the left and low on the chart that was shown. That was the bubble chart that had closing costs and interest rates. So Asian communities, most of the subgroups had not only very low closing costs, but also very low interest rates. Whereas if you look at the higher right portion of that chart, you would see Black, some Hawaiian or Pacific Islander subgroups, and some Hispanic subgroups had not only higher closing costs, so skewing them farther on the x-axis, but also higher interest rates, so higher up on the y-axis as well, while white borrowers had an average interest rate, like average as in close to the average national average interest rate, but they also had some pretty lower closing costs, and that's by virtue of white and Asian borrowers more predominantly using conventional loans, whereas Black, Hispanic, and Hawaiian or Pacific Islanders using government insured loans, which, as we mentioned, tend to have higher closing costs.
I can probably briefly address one final question, which is around how do we reverse the African-American trends that we're seeing in the data? And, what are banks or mortgage lenders doing to make more loans to African-Americans? I think the NCRC is focused on this effort in two ways. In some ways, we're working closely with our housing counseling agencies to advocate for increased down payment assistance, which we think would be helpful as potential home buyers are looking for a loan to purchase their first home or their second home. But we also know the role that lending institutions play in terms of relaxing their kind of qualification requirements, particularly for riskier low wealth individuals, including those who are African American. So I think we need to think a little bit more about innovation in this space. How do we go beyond the credit requirements to think about other ways to validate applicants' financial condition and risk in payment and things of that nature. I think it's going to take some conversation on the institution side to really think about both the product and processes that would increase that number and reverse that trend. And again, for a membership plug, we're so looking forward to ideating and exploring those trends, those initiatives, those ideas with you all in partnership with both our institutions and our grassroots members. So please do plug in and let us know.
Thanks, everybody. I know we didn't get to some questions. Please feel free to email me or Josh or Jamie with any questions you might have asked but didn't get. Actually, a big long one came in. Yeah, sorry guys, we're out of time right now. I really appreciate your time. And if you have any questions on the report, please let me know.
Thanks, everyone.